Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Surabhi. Guys, hi, morning.
Hi, good morning. Hi, morning. A brand new day.
Green today again.
I don't know if it'll last, Prashant. That's the question.
I should have worn a green tie.
I thought that there's so much, the market is so dull, it's so boring, so let's spice it up a little bit by, wearing some color. It automatically cheers up your mood. So
that is
I don't know if it's going to cheer up the market's mood. That only time will tell.
Yeah, absolutely. But I think we've got some green, right, to start with, in the US especially. And I think let's take what we get, basically. That's the position that we find ourselves in. Let me just quickly run you through what happened overnight. There was a bit of a relief rally in US stocks. Nasdaq actually ending about 2.25% higher. The S&P 500 a little less. It's basically pulled back at the day's high to the 200-day moving average. That's point number one. Now, the bank index, right now, it's not to say that this basically shows you that all the troubles in the bank sector, financial sector is behind. But prices, markets price things in very fast. So we had the broad KBW bank index, which was up 3%, and the KBW regional bank index ETF was up 2%. So this is the troubled part of the market, which itself is starting to see a little bit of pullback. We had the big data point, which is the CPI number, the consumer price inflation in the US, which is still running hot. The core CPI came in higher than what was expected. The headline was in line. What does that mean? It basically means that the Fed's job is not done. Core CPI, and by the way, people like economists at Citi, etc., are saying that this February CPI, core CPI number shows that the number is going to run strong for several months. So basically, the Fed's job is not done, which means more rate hikes have to come, which means yields have to reprice themselves. So they did. And the table will come up on your screen. Look at the yield curve, 2-year, 5-year, 10-year. These are gigantic moves, but the fact is this is only a fraction in terms of reversal of what we saw the moves day before. We had 50 basis point in terms of a move on the 2-year, and we reversed about half of it, and from 4% we went to about 4.24%. How do the market pricing? This is market interest rates, right? But the market pricing of what the FOMC in March will do has not changed much. It moved up about 5 basis points. Market is saying in March, on 22nd of March, FOMC will hike by 20 basis points. Terminal rate about 5%, but there will be rate cuts in the second half of the year. So this is still a very conservative pricing in light of the stronger than expected core CPI numbers. And you can blame this, or you can kind of thank this and kind of give thanks to the financial sector troubles. Markets have been fragile. Now, the point is there is still a few days to go between now and the Fed meeting. What happens if markets kind of see more relief rallies and the index goes up another 5-6%? Things will look very different. Markets rallying are financial conditions easing, which then will allow the Fed to do a little bit more. So things will be fluid. I mean, keep that in mind. Now, coming to sort of the local market here, we've seen a 700-point fall, right? I mean, in the last 3 sessions, that's 4%. That's a very large fall that we really saw. In that regard, I think we'll be deserving of a pullback. Sometimes when the momentum is very strong, very oversold conditions can be ignored, but not for very long. I would say in the very near term, watch for the Nifty to trade above the 17,220 level. It's a sort of technical level. By the way, the market got to 17,220 and then exactly from that point sold off. So let the market trade above this level for some time before you decide to take long trades. This is, of course, from a trading perspective. A similar level in the Bank Nifty is to watch for the Bank Nifty to get past the 39,740 level. And once it kind of shows you willingness to trade above this, I think you decide to go long, at least test the waters with some long positions. From a slightly more sustainable basis, we need a positive daily close, which is possible we get today after what has been a pretty tough last 3 sessions. Sonia.
I thought you'd say a pretty tough 2023, right? I mean, the year so far has been what? The Nifty has lost 7% this year already.
Yeah.
It's down 10% from its 52-week high. So forget about the tough last 3 days. It's been a tough year. Hopefully things will improve. But, you know, even if the pullbacks come, right, as you were saying, I mean, a lot of things have improved overnight. There's a lot of green across the screen. But even if the pullbacks come, they could be shallow. That's because if you look at the texture, it is very weak for the market. It's been 4 days running now that the Nifty has been under pressure. As I said, it's down 10% from its 52-week highs. It's down 6.5% this year already. And there's been large FI selling yet again. So yesterday as well, FI sold about 3,000 crores. It's 3 days running. We've had a 4-digit figure in terms of FI selling. And now in the last 4 trading sessions, over 7,000 crores has been pulled out by FI. So the screen is not looking good. Even if you get a pullback, it could be very shallow. At the same time, I don't think it's a right time to short this market either. So in that context, perhaps wait and watch is something that you could do. A lot happened overnight. Despite the Dow seeing a recovery, there are some negative signs. Moody's cut their outlook on the US banking system to negative. You had a big fall in Brent, by the way. Brent is now at a 3-month low of $78 a barrel. So there are demand concerns there too. And a couple of levels that I'm watching out for on the index itself. The next level will be the September 2022 low of 16,818. That was a level we were watching yesterday as well. We're still a little bit away from that, but if the sell-off resumes, which it could, I mean, things could go either way. There is a pullback today, but it could get sold into. Next level to watch on the downside. And on the upside, the 200 DMA of 17,400 to 17,450 is acting as a key resistance. The important point to remember is this: although the US CPI inflation data has cooled off to 6%, it is still well above the Fed's targeted inflation rate of 2%. So there's a lot of work yet to be done for inflation control. And in that context, things could go either way in the March 22nd meeting of the Fed. So all in all, yes, there is some green, but whether it lasts, I'm not too sure.
I guess that's the million-dollar or the billion-dollar question, right? But just to reiterate some of the points, Prashant, you mentioned, I think if we hadn't had this entire SVB incident, then what the CPI numbers have done between the jobs report and the CPI number, I mean, you started off with expectations of a 50 basis points rate hike on the 22nd. Those expectations have been pruned down to 25 basis points. I mean, that's what's happened. But then we had a mini bank blow up, 2 banks blowing up in between. So that's the first point, that the inflation number.
How you call it mini bank blow up.
The mini bank blow ups, right? But thank God we didn't get to anything bigger than that. So yeah. $200 billion in asset, maybe the market, wants to digest that and just move on. And that's what the mood seems to be like today. That's the CPI data. The market also ignored what Moody's said yesterday, and maybe the market has good reason, because a lot of the rating agencies were pulled up for being way behind the curve back in 2007 and 8. But for what it's worth, I mean, I'm just quoting what Moody's is saying. They said so they've changed the outlook for the entire banking sector, by the way, not just 1 or 2 banks, the entire US banking sector, from stable to negative. And they're saying that the outlook change reflects a rapid deterioration in the operating environment following the failure of SVB, Silvergate, and Signature Bank. The market completely ignored that. The market wanted to, latch on to relief and get a relief rally going, and that's what happened. There was also some geopolitics. By the way, there was a drone, and there was confusion between whether it was shot down, and then it came to light that it was a collision. But basically, you have drones up in the air, and it was a US drone that finally went down. But again, the market moved on beyond that. The market was in the mood to latch on to that relief rally. So let's see if that can play out today. In India, additionally, apart from all the global cues and the yields, I'll watch out for Reliance, quite a bit. We have some news, and we'll get Rima to give us more details on this. Interesting stuff happening. It seems that Reliance wants to make deeper inroads into the premium segment with their postpaid plans. They've announced some new plans. Let's see if that moves the needle on the stock, because the stock has been an underperformer. It's actually down more than the Nifty this year. Nifty is down about 5.5%, 6%. Reliance is down well over 10% this year. So is Reliance poised for a bounce, for maybe a bit of a short covering, if nothing else? If that happens, we know that's excellent for the market. And likewise, I'll watch out for the banks once again. And we had some evidence come in yesterday. Yesterday, the Bank Nifty did not fall as much as the Nifty. So the next level that I'll watch out for is the 200 DMA. The Bank Nifty is just below the 200 DMA. It broke that effortlessly in the decline. So can banks start seeing some money come back, and will some shorts start to cover? Tomorrow is the weekly expiry. So I think Reliance and banks put together will offer an interesting perspective from the bull standpoint to see if this can be a good bounce. Bigger question is, this market has become a sell on rally, as we say. Yeah. Will the rallies get sold into? That was what was happening yesterday. All we have today is a couple of hours to figure out.
You know, just one more headline that everyone's talking about now is what's happened with Apple, right? They've decided to A, delay their bonuses and B, limit their hiring. So once again, a hiring freeze on certain pockets. And that says a lot about how this A, funding winter is not over, and B, this layoff situation, right? I mean, it's been going on for a while and now it continues. So.
Forgot to mention Meta. I mean, Meta is, slashing 15,000 jobs, closing 5,000 open positions, and this is over and above the 11,000 cuts they did. But again, as I said,
this is before the recession, impending recession.
You know, but I was reading somewhere that in terms of just the headcount, right, the total workforce in the US, tech constitutes I mean, these numbers are huge, and these are well-paying jobs, right? Relatively well-paying jobs. So the impact on purchasing power, demand, etc., perhaps is disproportionate. But numerically, it's a very small percentage. I mean, you know, if you when you look at the labor market numbers and you say, well, we're seeing headline after headline of layoffs, but the labor market number is still very strong because it's a small percentage of the overall pie.
Overall market. All right, let's kickstart the show. In fact, we have plenty of stocks to talk about as well this morning. So without wasting any time, first up on the equities front, we have Venugopal Gare of Bernstein, who says that until now, India's macro moderation does not place it as an outlier, and recent data suggests some acceleration in consumption and industrial demand. However, he adds, as China continues to see a recovery in activity and its rub-off effect is expected to benefit other ASEAN countries, the nature of the US slowdown will play a role in dictating the risk to growth this year. He says a hard landing in the US is not good for exports, and in that respect, India may end up holding better. But domestic risks such as weak monsoon, inflation impacts, and lack of macro buffers may still present a downside risk to the GDP forecast. He also adds what he sees for now suggests that India's underperformance with EMs in general may not persist for long, and a valuation correction could make him more optimistic.
Okay, that's on equities. Let's move to the money markets now. And here are some views coming in from Kunal Sodhani, Option and Bank. He says, in response to the US CPI report, the dollar index printed minor gains and yields rallied. He says Brent crude prices sharply cooled off and core CPI rising month on month suggests that inflation is stickier than estimates. He adds that the dollar index remains under pressure and it appears is still supported by recent lows of 103.5, an area coincident with the provisional 55-day simple moving average. Below the latter, Kunal says the dollar could slip back to the weekly low at about 102.58. For the USD INR pair, he says 81.95 acts as a support, while 82.55 is a resistance.
All right, and on the bonds, Neeraj Gambhir of Axis Bank says the 10-year benchmark bond yields traded in a range of 7.33 to 7.45% for the week. He says bond yields eased with curves steepening on account of global risk-off sentiment due to the SVB fallout in the US. He says India February CPI came in at 6.44% in line with market expectations, and he expects the 10-year benchmark to trade in a range of 7.32 to 7.42% for the rest of the week ahead of the US FOMC meet.
All right, we have plenty of stock-specific action lined up today that we will track for you as well. So in just a bit, we'll get our top 10 segment going. Today, we're looking at Maruti Suzuki, Reliance, LTI Mindtree, PVR, Voltas, RailTel Corp, PNC Infra, GMR Airports, and Dixon Technologies. All of those on the back of positive news flow. ONGC is the only stock on our radar that could perhaps open in the red.